SADAFCO, the SADAFCO and UHT milk, tomato paste, and ice cream, listed as $22.70 in 2025. Revenue held at $2,999 million reals. Net income held at $477 million. The milk powder cycle bit the margin. The fortress held. The plan rebuilds it. This is the complete CFO and business report. 3 signals stand out. First, the powder cycle bit hard. Gross margin gave back 459 basis points. Second, the profit held at 477 million reals, but interest and other income did the holding. Third, the balance sheet is a fortress. No bank debt, net cash, and buybacks running. The plan runs 6 actions on 1 road. Powder procurement with 6 months of cover. Pricing and premium mix. Growth beyond the drinks aisle. Depot and capacity investment. A formal base plus special payout. And digital routes to market. Sequenced from 2026 to 2030. Each action has a gate before the next. The SWOT is honest. The strengths: SADAFCO brand leadership, the best margin in its class, and a net cash balance sheet. The weak points: imported milk powder dependence and profit leaning on non-operating income. The opportunities: pricing, premium mix, and captive Polish supply. The threats: powder cycles and the Chile price war. Michael Porter's 5 forces, drawn on the dairy shelf. Supplier power lies in world milk powder markets. Buyer power is medium. SADAFCO is a must-stock brand. New entrants face the brand and a 20 depot wall. Substitutes press from the fresh dairy chiller. Rivalry stays moderate. The brand keeps the shelf. The model is a machine. Sourced skimmed milk powder from world markets, including the company's own Polish plants. Recombine it into UHT milk, tomato paste, and ice cream. Move it through more than 20 depots. Then the brand link. SADAFCO, on the table since 1976. Milk anchors volume. Paste leads the pantry. Ice cream scoops the margin. 4 pillars carry the operational plan. The people pillar: depot and route talent, Saudi national hiring, and service-linked incentives. The technology pillar: powder procurement analytics and demand sensing by depot. The infrastructure pillar: capacity, depots, and the Polish integration. And the digital core: routes, trade portals, and one data spine. Every risk carries a probability, an impact, and a named owner. The milk powder cycle is high and high, owned by the CFO and procurement. Chile competition is owned by the commercial team. The payout policy itself has an owner. The board, tied to free cash flow. That is deliberate. Governance keeps the plan honest. The board sets risk appetite and watches the register. The audit and risk committee owns controls and capex stage gates. Management delivers a monthly KPI pack, a quarterly board review, and an annual plan refresh. The context is Saudi. Vision 2030 makes dairy self-sufficiency a priority, and the school lunchbox keeps the carton defensive. Tourism deepens food service. The single biggest variable is the world milk powder price, and the real stays pegged at $3.75, so the cost base is a dollar story. The portfolio, drawn product by product. SADAFCO milk, the daily carton. Tomato paste, category number 1. Ice cream with SADAFCO and Babu. Cheese, butter, and ghee. Household milk powder. Crispy snacks, flavored drinks, and food service packs for the kitchens. One brand carries the aisle. Peer comparison: at live market caps, SADAFCO trades near 7 billion reals. Now the like-sized contrast: Nadec farms and sells more, 3.5 billion of revenue against 3. But SADAFCO keeps more, 15.9% net margin against 11.2. Asset-light recombining beats farming for margin. Valuation, with every assumption on screen. Risk-free, 4.45. Saudi equity premium, 5.01. Adjusted beta, 0.6. The WACC lands at 7.4%. The plan discounts to 391.5 reals per share. The market says 217.5. Read the grid, not one number. No buy, sell, or hold verdict ever. 5 catalysts to watch. The powder cycle turns, with cover locked in. Pricing and premium mix land through 2027. The summer scoop scales. Gross margin crosses 34% by 2028. And the cash machine compounds, with base plus special payouts funded by free cash flow. One grid, 10 years. Actuals in green, plan in blue. Revenue climbs from 2,170 million to a plan 3,756 million reals. Earnings per share builds toward 18.68, and the payout stays generous, funded by cash. Labeled illustrative on every panel. 5 years in one picture. Revenue built steadily from 2.2 billion to 3 billion reals across a fiscal year change. Net margin climbed from 9.6% to nearly 16%, then held through the powder squeeze. The share went from 169 to 217. Quality priced like quality. 2 pictures explain 2025. The gross profit bridge is 1 line long. Skimmed milk powder took 125 million reals. Volumes held, and the cash picture shows 75 days in the cycle. With powder stocks, the working capital lever. 10 days of discipline frees roughly 80 million. The transformation map is a road that protects a fortress. 2026, powder cover lock. 2027, premium mix lands. 2028, gross margin back above 34. 2029, the cash machine compounds. 2030, the fortress margin held. 1 road, 5 gates. 9 numbers hold the budget up. Growth of 4 to 5% a year. Gross margin walking from 31.8 to 34%. Capital spending at 4.5% of revenue, easing to 3.8. Zakat and tax near 5%, and a payout near 80%. The balanced scorecard makes it accountable. Gross margin, 34% by 2028, owned by finance and procurement. 6 months of rolling powder cover, owned by procurement. UHT share held at number 1, owned by the commercial team. Every target has a cadence and a name. The 5-year plan, in numbers, revenue builds from 3,134 million to 3,756 million reals. EBITDA recovers to 23.2%. Earnings per share reaches 18.68. Payouts stay near 80% of earnings. All of it labeled illustrative, not guidance. The master budget allocates 2027, month by month. Ramadan begins on February 8th, and the table fills with milk, Laban and tomato paste. February and March peak. Then summer hands the budget to ice cream. July and August hold high. 12 months weighted the way the kingdom eats through the year. 3 final charts close the budget. The Ramadan quarter leads the phasing. Of every 100 halalas of budget, cost of goods takes 67, and EBITDA keeps 22.2. Firm cash compounds to 2,909 million reals across the plan. The complete SADAFCO report is live at cfoinb.com. That is, cfoinb.